So the agenda for today, we'll be discussing the demand and need for large loans, so large lending trends and also opportunities as we progress through 2024. We'll also be discussing our lending and security appetite. So understanding the appetite across our product range and really bringing to life our appetite and our criteria with some recent case studies that we've supported SMEs, consumers and investors with. Then we will be going through how to structure a referral for us to be able to give you a swift decision for both your regulated and your unregulated questions. And as I say, right at the very end is when we're going to cover the questions. So to start us off, we'll be discussing the demand and need for large loans. So the large lending trends and opportunities in 2024. So first of all, I'm going to hand over to my colleague, James Briggs.
Thanks, Michelle. Morning, everyone. Thanks again for joining us this morning on the Chalk Live webinar. So I've got a few graphs to share with you over the next few slides, just kind of highlighting the opportunity there is for large lending in the residential sector in particular to begin with. So we start off to put some context around the opportunity of this opportunity. We've summarised some data from a few different UK sources. So we've taken data from UK Finance, from the Bank of England and from 27 Tech from a sourcing perspective. So the first slide we're going to look at is regulated purchase and remortgage transactions. For the purposes of today's webinar and my data, I'm classing large residential transactions as transactions above £500,000, so £500,000. So getting into the graphs then, we've got two graphs. The one on the left looked at the percentage of loans written in the market, purchase and remortgage, above 500,000. And on the right, we've got the large loan share of the market overall as a percentage. So we've plotted data from 2019, which is the last year of normality, through to 2023, the most recent data we've got, and it shows some really interesting trends. Both graphs show a similar trend. So if we start off with the blue line, which is 2019, we can see the large loan share is fairly flat in the market. It hovers around 3 to 3.5%. So that's a really good base point for comparison. Moving on to 2020, which is the brown line, the first half of 2020 is fairly consistent around that 3.5% mark. And then we've got some major events that happened in the world and the UK, which caused a bit of turbulence within these graphs. So in March 2020, we went into lockdown. So what you would expect to see, and what we maybe expected to see back then, was the number of mortgage and large loan transactions in particular start to nosedive. But we can see from this graph that actually the opposite happened. So in the second half of 2020, we almost touched 5% of all transactions being large loans. A couple of reasons for that could be the number of larger properties that are being sold as just distressed sales because of what was going on with lockdown. But also we went into the stamp duty holiday in July 2020. So just as a reminder, no stamp duty to pay on residential purchases for the first £500,000 of the purchase price. So if a buyer was purchasing, first-time buyer or second-time buyer, a house for £500,000, there was no stamp duty payable at all. So that decision definitely stimulated the market and the large loan market in particular. Moving through to 2021, we can see now the green line. There's a significant uplift in the large loan transactions through to a peak at 7.5% of all transactions being north of 500,000 in June 2021, and then we see a sharp drop off down to below 3%, and that's when the stamp duty holiday ended. So we can see it peaked at 7.5% of all transactions and 22% of all lending being large loans. Moving on to the purple line, we saw some recovery up to 6% again, and some stability returned to the market for the first 3 quarters of the year at least. And then September 2020, we had the mini budgets, which we all remember, caused a lot of nervousness in the market, and we saw that drop off at the end of 2022. Drop-off was very short-lived, though. If we look at the red dotted line, which is 2023, so strong growth in the large loan sector. Couple of temporary pullbacks, but growth never goes in a straight line. Between Jan and October in that year, we saw large loan growth from 6% to 9.5% of transactions, and over 30% of all purchase and remortgage transactions were north of £500,000. So real positive for the market there. Interesting to note that we've seen 3 consecutive months of growth from August, which was the last time that base rate rose. So just as a summary for these two graphs, great story for the potential of the large loan market. So despite stagnant house prices, some regional corrections, it definitely shows that the large loan market is more immune to some of the economic challenges and affordability pressures that face the rest of the market. Thanks, Michelle. Okay, moving on to graph number 2, we've got specifically the purchase transactions. So apart from 2022's record year, which is the purple line, peaking at 21% of large loans, 2023 was above all other historic performances, holding between 15 to 18% of the purchase market share being categorized as large loan lending. Let's not forget as well, that was a year that saw 5 base rate rises and significant cost of living challenges. So again, it reinforces just how resilient this part of the market is. What we saw in conjunction with the strong purchase market on large transactions was real strong growth in regulated bridging in 2023, particularly as customers seek to unblock chains, take advantage of a buyer's market, as well as a lot of older borrowers taking control of transactions and downsizing. And we've got a good example of that when we look at the case studies. Thanks, Michelle. Okay, slide number 3 is a 6-month view on sourcing data, and we've got this courtesy of our partners at 27 Tech. So this looks at the ESISs, or mortgage illustrations, if you like, generated. And it's worth bearing in mind the 3-month lag, typically 3 to 5 month lag. So the ESISs produced in October, November, December will drive application activity in the first quarter of 2024. It's really encouraging this to see that total illustrations growing by 26% from 65 billion in July 23 to 82 billion in November 23. So a real good sign of confidence in the market. So other than the expected seasonal drop that you'll see in every December, the overall market and the large loan share of the market have both seen growth since September 23. The red dotted line is the large loan share of the market. So we can see that it's grown from 12.2% of the market in September to 14.2% of the market for illustrations in November. So that small percentage increase equates to 4 billion plus in additional large loan illustrations issued in a very short period of time. Thanks, Michelle. Okay, and the final graph that I wanted to share with you looks at the mortgage approvals and the specialist share of the overall mortgage market. So we've established from the previous slides, I think, that there's a real opportunity in a growing large loan market. So I wanted to understand how much of the overall market is specialist. So we looked at the spread between specialist lenders and other lenders. Now, Bank of England, where we obtain this data, reports specialist lenders as non-banks, so lenders that are unable to take deposits. So in reality, the specialist share is actually greater than what's demonstrated here, given some of the specialist lenders in the market are also deposit takers, and you've got some deposit taking building societies that are targeting specialist sectors. So the light blue mountain range in the background represents the overall specialist share, and it's a steady 5 or 6% of the market in 2022. But we can see as we move towards the right-hand side of the graph, 2023, we've seen sharp growth, and it peaks at 10.5% in November. So over 10% of the market plus is specialist. So wanted to kind of understand really what's driving that share. So there's two lines on the graph as well. You'll see the red line, which is the purchase specialist share of the market, and the green or teal coloured line, which is the remortgage share of the market. So both have grown since Jan 22, but the significant growth come from the remortgage activity, that teal line, with particular growth in Q4 of 2023, which is encouraging. So clearly, over time, some of the economic challenges are playing through and driving the specialist sector, whether that's more clients with adverse affordability challenges, less stable employment due to redundancy, or a higher share of self-employed borrowers. But one of the key opportunities for the specialist share, and one of the big drivers for that remortgage uplift, is debt consolidation. So over the last 12 months, Bank of England have reported consumer credits risen by over 8%, which is really significant and they think is unsustainable. That's inevitably going to lead to more opportunity in the specialist space for specialist remortgage and second charge lending. So second charge lending, in particular for those clients that need to address debt consolidation issues midway into a fixed rate period where further advance isn't available. Okay, so just to summarise that and the previous graphs, I would say that the data tells us there's loads to be positive about coming into 2024. Most economists have started to revise their forecasts upwards, and they believe we're going to have a far stronger year than was originally anticipated. Great news. In particular, slowing pay growth and a larger fall in inflation than was projected, partially because of energy and food prices peaking, have led analysts to believe that we're going to start to see a base rate reduction earlier than originally thought, potentially summer or autumn 2024, which inevitably will boost confidence further and drive more activity in both the traditional mortgage market and the large loan markets. Thanks, Michelle.
Thank you for that, James. It's really great to see the trajectory of the demand and need for the larger loans in the regulated space, and also to see the growing need for the specialist lending as the gig economy continues to grow. So thank you for sharing those stats with us today, James. So I'm going to talk through the opportunities for buy-to-let and the commercial market space. So I think we all pretty much face the hit, with buy-to-let being the most severely affected by rising mortgage costs than mainstream mortgages last year. And as a result of this, in 2023, we saw a sharp drop in buy-to-let lending, with the total borrowing down 46% for the total of 2023. That said, however, our forecasting is positive. So we're seeing a growth of up to 50% of these figures over the next 5 years. Those coming to the end of their fixed rate period will be put under cash flow pressures. However, there is still opportunities for many investors across the UK. Now, recently we conducted a survey with investors and landlords, SMEs, developers across the UK. And today I'm going to share with you some statistics around our findings. Now, whilst our survey identified that while some developers and landlords are scaling back or exiting the market, the vast majority committed to developing their portfolios and even taking advantage of temporary cuts in property prices to expand. So despite inflationary and mortgage volatility over the last 12 months, our report has found that 34% of buy-to-let landlords who have portfolios of 4 or more property are gearing up for further expansion over the next 12 months. So that's very much shrugging off the tough market conditions. Those with lower geared portfolios are certainly in a better position than those who perhaps are struggling with the cash flow pressures and ability to do a rate switch if they are looking at higher geared portfolio and being affected by the higher rates that they're seeing today with their rates coming towards the end. In fact, a fifth of those portfolio landlords who are looking to expand are actually looking to diverse their portfolio. So what we have seen is an increase in demand for student-let properties and social housing. Social housing is a key area for us that we have seen significant growth here at Together, and it's an area that will continue to grow. By diversifying portfolios, it enables landlords to achieve higher rental yields than standard single family let property. So there will be that continued growth. And as we see, 23% will continue to diversify. Now, last year was understandably a challenging year in the commercial market as well. So again, volatility in inflation, mortgage interest rates, devastation overseas, and the cost of living crisis. Now, new lending across the market was down circa 33% from 2022 figures, so quite a significant drop. However, the scale of the opportunity across the market remains significant. And to put this into perspective, the total secured commercial lending is predicted to rise 32% from an estimated 90 billion in 2023 to a figure of 118 billion by 2028. So what that tells you is a significant growth opportunity in the commercial market to maximize with your SMEs and investors. Now, more than half of the individuals, so 58% of the respondents that we surveyed, would recommend investment into the UK commercial property market now, despite the events of last year. So this comes as 42% have seen an increase in revenue in the past 12 months. Now, whilst 16% of commercial landlords are exiting altogether, what this does is it opens doors for a new generation of professional landlords and developers to step in. Now, regionally, those surveyed in London, the West Midlands, and in the northwest of England will be buying more commercial properties in those regions over the next year. Overseas investment, we mentioned that in a previous webinar, we covered overseas nationals because it's a key strength of ours. It's a key USP of our flexibility with lending for these particular types of customers. But overseas investment in the UK commercial market last year, just in Q4 of 2023, totaled £6 billion. So that accounted for more than 80% of the total purchase market in Q4 last year. Now, Birmingham and Liverpool are the top two choices for overseas investors looking to place bets on UK regional cities next year. 68%, so whilst 10% of all of our respondents admitted that they have got reservations about the outlook of their business ahead of 2024, 68% feel optimistic, with a quarter planning to refinance their properties to support further business growth and business investment. Now, in terms of times of austerity, mainstream lenders' appetite and lending criteria does tend to wane. So this is where specialist lenders step in. Now, 42% of all respondents that we surveyed said that they would prioritise using a specialist lender rather than a mainstream lender when looking for finance for their commercial property transactions. Top 3 reasons for this are the following. So specialist lenders are prepared to take a greater level of risk, grant larger loans and support entrepreneurial plans. For ourselves in particular, my colleagues, Chris, Dan and James will be talking through a bit more of that appetite later on. However, it's certainly our flexibility support, new business startups that really helps that growth and customers identifying that specialist lenders can support them with their needs. They are the fastest, so 29% have said that specialist lenders are the fastest at providing them with the funds that they need for their transaction. Certainly here at Together, that's a key area. In addition to our flexibility of criteria, the speed as to which we can complete is key, and the certainty of the funding is also key. Some commercial term lenders, certainly in the mainstream space, can take some time with the level of due diligence and underwriting and documentation that you've got to provide for those cases, can take several months. But this is where we certainly come into our own, and Chris will be sharing with you some case studies as to where we've managed to work at speed. Specialist lenders are also noted that they provide the best level of service. So not only is this connected with the speed, it's also the ability, certainly here at Together, that you have got direct access to our underwriting arm. Chris, as I mentioned earlier, he's one of our senior underwriters in our corporate team. So he works with the BDMs in our sales team to support with referrals for larger loan transactions. Same goes for our regulated side of the fence. So what this shows you, 42% of respondents are working or will be working with specialist lenders. So in addition to the growth opportunity there for buy-to-lets over the next 5 years, commercial over the next 5 years, working with and understanding what support specialist lenders can offer your clients is really key to maximize those opportunities. So now I'm going to hand over to my colleagues, back to James Briggs and Chris Johnson, and they're going to be talking through the lending appetite and our security appetite across our product range. So this is going to bring to life some of the recent case studies to really share with you how we were providing solutions to customers in this space. So first, over to Chris Johnson.
Thanks, Michelle. Hi, everyone. So yeah, just going to talk to you a little bit about what we do with larger loans in Together. So I work in the corporate lending team. We're a small team with experts who are used to dealing with banking type facilities, large and complex transactions. So essentially, we kind of route the larger deals through that team just to have a better understanding of what's going on with that customer and actually give a tailored response to each transaction on its own merits. So yeah, just in terms of what we look at, they're the same few things that we would assess. You know, what's the asset we're lending on, affordability, customer track record, what's their strategy, and what's the exit. But I guess you can help us really when you're submitting these inquiries and applications by just maybe giving us a little bit more detail to help us actually understand some of the things that we need to when we're looking at larger loans, and just maybe looking at those in a little bit more detail. I guess the better the picture you can paint at the start, the quicker we can respond, and obviously the quicker we can get the application moving. So I think we can really all work together on that to deliver for the customer. So yeah, as it says there, you know, we look at some really unusual properties. I don't think we necessarily approach anything with a flat no. We like to look at each case in its merits and actually, you know, make sure that we can try and support where we can. So, you know, one of the key differences with what we do is we won't just ask for an accountant certificate as a matter of course, or we won't just look back at historic. You know, we can look at the customer's financials, MI, you know, cash flow forecasts. We can analyse their business plan. So, you know, coming back to Michelle's point around, you know, startup businesses or businesses that have had a few issues maybe through COVID and are actually presenting a case of what they're going to do to improve that business. You know, we can work with the customer to understand that and actually buy into supporting them. And, you know, we do operate in a bit of a different way to banks and mainstream lenders. So, you know, we put out sort of maximum levels, which we've kind of tabulated here. So on a commercial asset, you know, 65% on a refi, 70% on a purchase. For resi, you're looking at probably 70% on residential, refi, and 75% on a purchase. But, you know, we'll look at, again, each case in its own right. So if you've got, for example, you know, a £20 million property in London, and given what's going on in that market at the moment, you know, that's not to say we're going to apply a one size fits all approach. We might be a little bit more conservative on the LTV on that. And actually, if we've got an asset that we really do want to believe in it as an exception, we can actually push those levels as well. So as I say, it's all in the detail, really. Thanks, Michelle. So I've just prepared a few case studies here to run through, and it's just to give you a little bit of an idea of the kind of deals that we're doing. So when I joined together from a bank, I kind of had, I guess, a fixed idea in my head of what the type of customers that we would lend to and how that would differ. And what I've actually had my eyes open to is that we deal with a lot of the same customers. So there are big corporate entities out there who choose to borrow from specialist lenders like Together for all the reasons that Michelle said, speed, service, flexibility, common sense approach. The other key bit is that obviously we don't have ongoing information requirements. So we're not asking them to provide, quarterly rent rolls, management accounts. We don't put, covenants in our facilities to try and tie customers in knots. And actually, a lot of those customers who come to us maybe for a quick bridge on a purchase that the bank wouldn't be able to do in time, and they really get to like what we do and how we operate. And in a lot of cases, we're actually seeing those customers choosing to stay with Together and actually turn that facility out or bring us other deals down the line. So that's really phenomenal. So first case study, obviously £6 million capital raise. This was a really high quality developer, substantial business, as you can see there. They'd built a hotel, they'd let it, and they chose to retain it. They had a facility with one of the major banks. It was a revolving facility, but where they had to allocate certain types of assets. So they could only have a certain number of, say, pieces of development land without planning and then pieces of land with planning. And they were running into those internal limits. So despite the fact that they have a facility there to borrow from a big bank, they actually chose to come to us. Apologies. Hopefully that's just a test. There we go. They chose to come to us. We raised some cash for them against the asset that they'd already had, and they were able to go off and buy some development land, which worked really well for them. They've since come back with another deal, and we've actually funded that in quite a short time scale as well. Okay, second example, this was a £6 million bridge to support the purchase of an office. It did have an outline planning consent for conversion to resi. It was a large overseas fund, really complex trust structure, multiple layers. So there was a lot of work to do around KYC, but we really bought into what the customer was doing. We really liked the asset. They actually wanted to do the bridge because they planned to go back and actually change and enhance the planning. So that was a big requirement for them, that they weren't actually ready to approach a development funder at that point. And that's where Together came in. So we were really pleased that we were able to support that customer. Okay, £3.8 million for a purchase of a development site. This was a large developer. They're actually owned by one of the big UK investment funds, so not short of cash. But again, even though that fund part owns them and we're happy to fund the development, it takes them time internally to actually sign off all the requirements. They effectively needed to complete by a really tight deadline to secure this site. It was a phenomenal opportunity for them, and actually without Together, they might have missed out on that opportunity. So they were more than happy to come to us, actually pay our fee. This is another example where from a one-off transaction introduced through a broker, they've actually come back again through that same broker and are wanting to do more deals with Together. So we've actually now completed the second deal for that customer, which again is a fantastic endorsement. Okay, this was a little bit different. So this was a business that actually didn't really want to borrow. It was a £7 million capital raise, family-owned business. They'd owned some holiday parks for years. They had an unexpected bill and requirement which they had to meet to avoid an issue with the tax. We completely bought into what the customer was doing, that they needed a quick bridge to meet a tight deadline. And I'm pleased to say that we were able to help them do that. We're working with the customer now around their exit to actually get that facility either redeemed, or in all probability they will probably turn part of that out and just get it onto a capital and interest loan for them to allow them to repay it over time. Okay, this one was a nice size deal, 9.25 million. Again, really experienced residential developer. And again, they were backed by quite a significant fund manager. So they were buying a site with consent as a care scheme. However, they didn't want to build that out. They felt that there was a better viable scheme there if they can actually change the planning to residential. It's in a really fantastic location. So there is an element of risk there, but again, we bought into the quality of the customer, their track record and what they're able to do. And in this case, they were actually buying the site for 18.5. So, they're putting in a substantial amount of cash ahead of us. And again, we were happy to support them to bridge the purchase whilst they revise the planning for quite a significant scheme. Okay, this one was a really great example where the customer had banked with high street lender for a number of years. They're in the leisure space, and effectively during COVID and beyond, their performance had suffered. They were coming up to expiry of their facility, and the lender was trying to put them on quite an aggressive amortization profile, which wouldn't have left them with any sort of spare cash flow. Actually, all they wanted to do was just park that debt on an interest-only loan with a lender that took a common sense view. Really good business, beautiful asset in a city centre, and obviously with the Hilton brand, and at 50% loan to value, it's a fantastic deal for us. So no doubt that we'll be able to get that one refinanced down the line. Okay, again, another really good operator, really good sized business that banked with a high street lender. And again, their business model had changed. So this was actually a used car sales business on a national scale. And that whole market kind of changed through COVID. So the way that people actually buy cars changed, where they didn't want to go to a large showroom anymore and browse. They'd probably already selected the car that they wanted to buy. And so this is a business that's been very successful in the past, but was having to effectively reposition how they actually operate. Again, we really bought into the people and the business plan and the professional advisors. But they just needed that time to actually work that business plan and actually show that. So for the bank, they wanted to see the financial performance immediately, and that's really difficult. Whereas together we could take a common sense view on that. And again, based on the security we had, we were very comfortable and we were able to give them the breathing space that they need. Okay, and the final example from me, this is a capital raise of 5 million against some quite specialist security. So, we commonly get an inquiry and it's something like, do you lend on quarries? And the answer is, well, we can do, but again, is it Mr. Smith who's just decided it's a good idea to go and buy a quarry? Or in this case, you've got quite a well-known player in that sector, experts. They'd acquired 2 sites through a share purchase transaction, and effectively they bought it from cash flow. They wanted to raise some money so that they could go and put it into something else. Really good business, strong financial performance, kind of a no-brainer for us, really. So we did obviously the due diligence. They had all the right licenses and everything else. And actually that's the kind of transaction that we're happy to support. But again, this comes back to the point of how that deal's presented to us day one. There's 2 different stories there, but actually it's the same deal. And the better you can paint that picture for us and actually get us to understand what that customer does and why we should support it, the quicker and easier that decision is going to be. So that's probably the big message that I'd leave you with, really. Always happy to try and help, as Michelle said, by supporting our colleagues and even direct inquiries from the brokers to try and give you a steer early on.
Lovely. Thank you for that, Chris. And I hope that has really brought to life the case studies and the level of lending, some really large transactions that we've been supporting customers with. And it's not necessarily just customers that fit into that specialist box. It's customers that can go to high street lending, but because of the service and the speed that we're transacting with and the simplicity of the underwriting, they are choosing to work with together instead of some of these mainstream lenders. So thank you for that, Chris. So now I'm going to pass over to James to talk through the personal finance opportunities and appetite.
Thanks, Michelle. Thanks, Chris. Yeah, really, some really interesting and diverse examples there in Chris's section. What's particularly pleasing to me about listening to that is I know at least 3 of those came from what we would class as residential partners, and it speaks to the importance of working with your client bank mid-term, particularly those self-employed clients that you've got in your client bank, and just talking to them about commercial opportunities, because there's a lot of movement in the commercial space at the moment, people wanting to take control and acquire their own premises on an owner-occupier basis to take control of their destiny. So please do speak to your self-employed clients about those opportunities throughout the term. I just wanted to go through just some of our kind of key unique selling points of the personal finance range, and just a few case studies about how they can be brought into life. So we'll start off with probably the key reason that we get used Together Personal Finance, which is affordability. And this, that supports the traditional lending that we do, but also the large loan lending as well. These are particularly useful. So you'll see the first one there is interest only. We've got interest only across our entire range of personal finance products. So that's the first charges and the second charges. What people love about us is we've got no minimum income restrictions, no minimum equity restrictions, although it is subject to plausibility how they're going to pay us back. And a lot of the high net worth clients opt for interest only and then make overpayments at a level that suits them. So very popular. The next one is our loan to income calculations. So typically on the high street, you're looking at 4.5 times income caps, maybe 5 times with specialist first charge lenders. We have no caps on our LTIs across our range. What we're most concerned about is the individual household affordability, not governed by affordability models like you see elsewhere or LTI caps. We're really taking a bespoke, flexible view and looking at that client's individual affordability. What we see in particular with some of our more entrepreneurial clients and the high net worth clients is they've got multiple income sources. So we can use 100% of all income sources, primary and secondary, which really supports those entrepreneurial clients with the higher borrowing requirements. Something we're absolutely revered for it Together is our attitude towards self-employed borrowers. We believe that they're the backbone of the UK economy, and more than 50% of our lending is to self-employed borrowers in Together Personal Finance. So we have a true 1-year minimum trading for clients, and from year 2 onwards, we can use 100% of the forecasted income for their current year. So if clients are on an upwards trajectory and they've got a borrowing requirement that can't be supported without a full year's worth of accounts, we can assist them, providing they've got an accountant. And we've got terms up to 40 years, so that can support the larger loan transactions, getting the repayments at a more affordable level. Then moving on, some of the other kind of categories where we really support the large loan market is the property element. So very comfortable with semi-commercial properties. We've seen a real rise in personal finance as a semi-commercial type of transaction at the moment. So those clients who are self-employed but want to trade from home as well, as part of their overall planning, it makes sense. And we've got an interesting example of that when we look at the case studies. Got properties with significant land, so we lend throughout England, Scotland and Wales. So we're supporting some of those higher value, large plot size securities. Doing a lot in Aberdeen at the moment, some fantastic properties up there with real kind of significant land that options with other specialist lenders aren't necessarily available. And we can help with those non-standard purposes. So the more unusual purposes tend to drive higher advance sizes. So that could be clients looking to capital raise for business use, tax bills, seeing a lot of parents capital raising through remortgage or second charge to help their children onto the property ladder. Plus we can do all of the large asset type purchases, so land, boats, even done some helicopters as well. So the real weird and wonderful large transactions. And finally, we can do multi-person applications in personal finance, so up to 4 borrowers on a loan. Not all borrowers necessarily need to reside at the security address either, so they're being used to supplement the income on applications. And to support our 40-year repayment terms, we can lend to borrowers who are up to 85 at the end of the term on a mortgage or 80 on a second charge loan. So some real kind of key selling points there. There's a lot of other kind of heritage parts of our criteria where we're extremely popular. So things like non-traditional construction, unusual property setups, clients with some credit blips, some credit issues. But these are the particular ones that support large loan lending. So to put some colour around those, I've just got a few quick case studies that I'd like to run through before we get to Dan's section. So here we have a residential purchase just under $1 million, 6-acre plot for some clients in Wiltshire. Weren't first-time buyers at that level, but they only needed 590 to purchase the property. Great, low LTV. But they were planning to downsize in 10 or 15 years when they get the spare bedrooms back and the kids move out. So interest only is a good option for them. The second applicant, so the chap on the application, he'd recently started a furniture restoration business. So this particular property was attractive to them because it had a barn where he could trade from on site. So clients had A1 credit, but affordability was an issue. Year 2 of the business, doing really well, needs to use the forecasted income, and even using that forecasted income, it put the LTI at 6.2 times. So real challenge on a couple of fronts: the self-employed, the time trading, and the LTI. Our solution for that, Michelle. Happy with semi-commercial. Clients have got to have an accountant to use forecasted income. This client did, so that was great. So we could use a year-end income. Downside, perfectly plausible rationale for going interest only, and the case met our affordability requirements. So we were more than happy to lend on that transaction. Number 2, so this was an interesting one, second charge loan. Clients in Harrow, fantastic property, and they were looking for a large second charge loan, 515 grand. Happy with it, repayment, 30-year term. Loan purpose is a bit of a challenge here. So they have 90k for a tax bill, and then some major home improvements that they were doing, as it says there. So indoor swimming pool and gym, absolutely fantastic. Why didn't they remortgage to capital raise? Well, they were a couple of years into a 10-year fixed with Nationwide, 3 or 4 years by the looks of it. Sub 3%. Clients absolutely did not want to disturb this mortgage. Those kind of rates aren't available at the moment. They've had some great advice taking a 10-year fix out at that kind of level. So the purpose was the big challenge. They did originally approach Nationwide for a further advance, but they were totally turned off by the tax bill element of the borrowing requirement. So for us, Michelle, our solution was we got comfortable with the purpose. Tax bills are fine for us. A personal tax bill that goes as a residential transaction. We just got some rationale around the home improvement works that were being done. So we saw a quote, 3 weeks, inquiry to completion, all of the funds released directly to the client. Very happy client and intermediary on that one. And finally, as I referenced earlier on with the regulated bridging, a very kind of common scenario that we're seeing at the moment, which is great. So we have an elderly couple. They've gone to view a property near to their children and grandchildren, fallen in love with it. This particular one, it was an open house. I remember it really well. Loads of interest in it. Went to sealed bids. They used regulated bridging to give them the power as a cash buyer. Their house is on the market, but they've not had any offers on it yet. The one that they were buying was a similar kind of value, but they didn't have all the cash to make the outright purchase. So regulated bridging, great solution for them. So the particular solution on this one was a cross charge. So the existing property was unencumbered, so we took a first charge on that, took a first charge on the new property they were buying, put them in a go position immediately, but more importantly, it gave them ample time to get a fair price for their old property, okay? And when that sells, all of the proceeds for that will clear our bridge and they'll be mortgage free around the corner from the grandkids. So really made a dream come true for them. So very popular type of transaction out there in the market at the moment. Thank you, Michelle.
Fantastic. Thank you for that, James. Again, I hope it's really brought to life some of the scenarios and case studies that we provided customers with these larger transactions. And in respect of the self-employed piece, James is bang on that actually it's an underserved market that actually, I think about over 65% of our regulated business is still for self-employed applicants because of our flexibility and understanding of the income for those individuals. So thank you for that, James. Right, last but no means least, I'm now going to hand over to Dan Narwell, who's going to be going through some information needed to enable our senior underwriters to make an informed decision on your customers' finance needs. So over to Dan.
Thank you very much, Michelle. Good morning, everyone. I think it's been great sitting back and listening to Michelle and James talk about the market earlier on, and James and Chris go through some case studies. And I hope you'll all agree that there's some fantastic opportunities there for you guys as brokers. What I'm going to do in the next few minutes is just discuss the referral process. Firstly, how to present a referral to us and the key stages of a referral and the information that we would need within that referral. Now, what I see, and I think Chris would agree with this, and our other senior underwriters would agree, is there's probably 5 key elements to a referral. First element will be the customer, and I think it's worth giving us the key information on the customer. If we're talking on an unregulated commercial transaction, it's what experience do they have transacting in the same sector or the same space that we're looking at presenting to the underwriters. For a regulated transaction, it would be a bit more about the client, asset and liability position, credit profile, that kind of thing. I always say with a referral, keep the information pertinent to what we're looking for. We don't want to be looking at pages and pages of information. Keep it key. And what that will do is that will help Chris and the other senior underwriters in the business make a quick, informed decision for you. Now, if we move on to the security, what is it that you're presenting to us, or what is it that the client's proposing we lend against? What's the value of that? Whereabouts is it based? Do you, as the broker, from speaking to your customer, see any risks with that security? And again, in your conversations with your clients, have you discussed any mitigants to any of the risks that are presented? As always, if you've got historic valuations, that will help us because we can read the commentary up front. But again, keep it pertinent to the security, and we always say that you guys as brokers are speaking to your clients. You have a whole host of information. You've gone through your fact find. You've gone through your due diligence on the client. Share the key points to us. If we move on to exit, and I think there's 2 stages to exit. You've got the exit if we're looking at a bridge transaction. what is the exit, first of all? Does it seem viable to you when you're speaking to your clients? And do your clients seem motivated to action that exit strategy? You've also got the element of, if we're looking at an interest-only facility, is the interest-only exit repayment vehicle viable? Again, do the clients seem motivated? The fourth part of a referral is repayments. So for debts that require servicing, how is the client proposing to fund the monthly payments? Do you have any concerns from the conversations you've had? Is the income sustainable? Is it viable that that will remain for the term of the facility? And finally, we like to look at the fallback option. In the worst case scenario, what is it that we are left with? What will our options be as a lender to getting our money back ultimately? And I think if we can answer these 5 questions, or put these 5 bits of information to our underwriters like Chris, I think it gives them the full picture, and they're able to make a quick and informed decision, which gets your client moving through the process of securing a property or arranging their next project quicker. So what we're going to go on to now, I just want to highlight what the referral process would be to, again, support you with getting the quickest decision and the most reliable decision. In the first instance, on regulated transactions, it would be speak with your BDM, account manager, or our telephony support team. With the 5 bits of information that I discussed on the previous slide, we will then refer your case into one of our senior underwriters, get that initial buy-in that it seems like something we can do. And then we've got a formal referral process that happens through our portal, My Broker Venue, where the underwriters will review things like credit searches and the wider case and confirm that you can go ahead to package the application and present it to us as a full application. And for unregulated inquiries, similar process, speak to your account manager or our telephony support team. Always have them 5 key bits of information on hand when you're speaking to your account manager, and then your account manager will take the inquiry away, present it to Chris and his team and his colleagues, and potentially go to credit committee in advance of you going through and gathering all of the documentation to get that initial buy-in that everyone's on the same page and we're able to support. And then once we've gone through that process of Chris and his team or the credit committee agreeing the transaction, we'll then come back to you and discuss how we present that case and how we process that case into us. So what I'd say a fairly straightforward process with 5 key bits of information that are required, and we can hopefully look to support you with the transactions and continue the growth in the space that James and Chris have already spoken about.